Hello, everybody. I'm Tom Dorsey. To my right is Jay. To my left is Ben, as you're already well aware. And this is the 19th of December, and I'll be surprised if anyone's here to watch this.
Week before Christmas?
Yeah, the phones are dead quiet.
Yeah.
Everyone's out like they probably should be, shopping and enjoying themselves and that type of thing. But still, the market continues on. And where we stand right now, the MOOPTI you mentioned to me had reversed up, right?
That's right. The MOOPTI, the MOOPTI, however you pronounce it, you can pronounce it anyway. But it's the percentage of stocks in the optional universe that have positive weekly momentum, and that's a cross that we look at between the 1 week and the 5 week moving average. And we just saw it reverse up, and it reversed up from a low field position around 22% up into 34%. So roughly 34% of optional stocks have positive weekly momentum. And this is really a low position compared to where we were, let's say, in that rally in October when over 92% of stocks had weekly momentum. So, if you're looking for some trading ideas right now, there's certainly some opportunities. I just use our query tool, which you can access on the database tab, and I just search for stocks and favorite sectors, positive momentum, positive trend. And I found some interesting names. One of them is Asana Retail Group. The symbol is ASNA. 4 for Fiver, positive trend. Its weekly momentum just flipped positive. Another one is the News Corporation Limited, NWSA, again positive trend, just broke a quadruple top. Interesting trend going for right now. And then also Helen of Troy Limited. This is in the household goods favorite sector. It's rising up above the trend line, 4 for Fiver, and positive weekly momentum.
I know that's
HELE.
30 years.
It looks great. Yeah, so if you're looking for some trading opportunities this week, consider some stocks that just saw their weekly momentum flip positive.
Well, somebody asked me, which they always do, said, tell me, how does the market look? I would say perfectly normal. Go to your welcome page, press that gray box, then click on the S&P 500, and you will see the most perfectly normal market you could possibly see. It is so evenly distributed. It's right where it wants to be. So what's the strategy when it's dead center? I harp on this continually. Covered writing. Buy stock, sell call is the name of the game. And this is the things that I do in my portfolio. I do covered writing. I feel comfortable doing that. I always have. For some reason, I always felt that I had the advantage when I start with your money in my pocket.
Yeah, it's a great way to look at it.
That gives me an advantage. And for the most part, statistically, 68% of the time you look at a normal distribution, Google it, normal distribution, you'll see the right strategy is a covered right, because most things are middling. They go up a little, they go down a little bit. Things aren't constantly skyrocketing up until you're in some sort of a bubble like the .com bubble, and they always break, and gold bubble and that type of thing. Speaking of gold, you have some information on gold?
Gold, if you look at the GLD, which is just the Spider Gold Trust, it violated a long-term trend line, hit 152 on its chart just last week, and you've started to see gold as it relates to some, even on a relative strength basis, gold as it relates to some of our other models start to and begin to rotate out. I think the Global X macro trends model saw gold rotate out of that. But it's interesting, in conjunction with that breakdown that we saw and have seen in gold, also last week, the dollar, you look at the DX/Y, has entered what we would consider to be a rising dollar period, and that's just defined as a move 10% off its bottom. So it back in August, it fell down to 76. It's now moved 10% higher today. So if we look back historically, there have been some pretty interesting and significant trends that have been in place during both rising dollar trends or rising dollar environments that we're in now, and one of those relates to commodities. Commodities and international equities are probably the two most glaring broad asset classes that tend to do poorly in rising dollar environments, again, like we're in right now. And that certainly would go hand in hand with some of this chart breakdowns, not only in gold, but also in some of the other commodities out there as well, and some of the other currencies too.
And if you just look at for other currency relationship is the dollar against the euro. We saw the euro violate its positive trend line for the first time in nearly 10 years.
Wow.
And this continues that recent series of lower tops and lower bottoms that has taken place in 2011. But what's also interesting is that we've seen continued lower tops, going back the last 4 or 5 years, starting in that April 07-08 time frame to October of 09, and then finally in April of 2011. We've just seen continued lower tops there. So it's a negative picture for the euro right now.
Yeah, you know, it's interesting too when you start to think about rising dollar in markets and what does well and what doesn't do historically as well. One of the best performing sectors during a rising dollar environment is the technology space. In technology, you think of growth names, and one broad-based ETF, you look at the Qs, the PowerShares Q Trust, QQQ. First Trust has an equal-weighted version, QQEW, and it just takes the 100 NASDAQ stocks. The PowerShares version is cap-weighted, the First Trust version's equal-weighted. Both look attractive here, but those are among some of the stronger, just broad-based, equity-based indexes, ETFs right now. Like I mentioned, either one of those certainly would be viable. There's also interesting if you just wanted a pure tech play within the NASDAQ 100. QTEC is a First Trust NASDAQ 100 pure technology, so it strips out all of the technology stuff. But so technology, healthcare, and finance, those are the three sectors during this period, during the rising dollar period, that historically have done the best. Interestingly, basic materials is the one that has done the worst, is the only sector during rising dollar environments. And this is going back in studies back to 1998, so about 18, 19 years. Basic materials has been the only sector that's actually finished rising dollar environments down for the year. So again, basic materials being your commodity related stuff, your precious metals, your steel, and some of the chemical type of names out there have historically been among the laggards in the equity market this time of year. So
It's interesting, if you pull that GLD chart up and you look at the $20 per box chart on that, you'll see that break of that trend line is a major break, because this is a long-term trend that begins at the bottom of 2008, when basically everything was in a meltdown. Still, gold in 2008, although everything melted down, didn't do that poorly. And it wasn't that safe haven, but it was part of the margin clerk's job to sell anything he could possibly get, and gold was part of it, to raise capital. So it didn't go down to its 1997 lows, but still, that was the low, and that's where this trend line began, and that has significantly broken. When you look at the dollar chart, I mean, it looks phenomenal.
Yeah.
You know, so if you were a currency trader, you'd want to be long dollar, short euro, and I would also be long dollar, short gold.
Yeah, you could do that in ETF. UUP is the PowerShares bullish dollar ETF. They've got, and I don't know the symbol off the top of my head, PowerShares has a triple up US dollar fund. And it's a PowerShares ETN. It's a note, so you can go, I think PowerShares ETN, or go to the database tab and click on our symbol lookup screen, and you can search for the symbol of that. But certainly there's lots of avenues, lots of ways to gain exposure directly to US dollar, or participate in those things that tend to do well during rising dollar markets. Again, US stocks are certainly one that tend to have good performance, more so in the growth space, and more so on the small and mid cap side as opposed to the large cap side. So just some trends, and we'll talk about more over the course of the week about things that do well, things that historically don't do as well during rising dollar environments. So those are certainly just a few names.
Yeah, and if you look at today's environment with the rising dollar, you know, certainly U.S. small cap, U.S. mid cap areas are currently the strongest equity groups. If we're looking at, you know, our asset class group scores on the mutual fund side, you know, along with some of the U.S. fixed income and real estate, while those that are tied to foreign currencies, you know, emerging market income, global currencies, international global developed markets, those are all down the bottom of that asset class ranking, which is all based off of fund score. You can see that those are the weak areas, while those U.S. equity, U.S. fixed income groups are up at the top.
And you guys recently added some functionality to that fund score page, didn't you?
We did. If you're a subscriber to Team Builder 2, and it's not, you get a whole suite of products. You don't just get access to Team Builder 2. You get some neat features on the group score page. And one of those features that I like is the alerts section, where you're able to set alerts for groups. And you can receive an email if, let's say, fixed income group drops below a score of 3. Or let's say all U.S. equity diversified moves in the top 50% of that group ranking. And it's just like, you know, setting action prices or set activity alerts for stocks. It's kind of similar for our asset class group score page. Another great feature, too, is also score history. You know, with this feature, you can find it, you know, on a mutual fund chart. It says fund/landscape. Or you can, if you're looking at an ETF, and you can go to the mutual fund tracking symbol, which is just simply type in Z, then the ETF symbol, then X. That will give you our mutual fund tracking symbol for that ETF. Go to Fund Landscape, and you'll be able to compare that fund to its group or multiple groups, And you can also compare that fund against other funds.
Mm-hmm.
So let's say if you have two technology ETFs, the QTEC and the QQQ, how do they stack up against each other going back the last 4 or 5 years? So you can see kind of the score history comparison. There may be certain market environments where the equally weighted is better than the cap weighted, or maybe when small cap growth is better than small cap value. You can see how scores relate to one another. So it's a neat feature.
Yeah, interesting. One of the things that we've certainly got a lot of questions about, and one of the things a lot of people are talking about now is yield and ways to gain yield and get yield into the portfolio. And there's lots of good-looking yield stocks, and we've talked about them over the weeks. But as you're beginning to look for new yield stocks at the end of the year, beginning of this year, one thing that is very important is to look at the technical health of it, not just the yield, but how does the stock look. I was doing a quick study just looking at GE as an example, General Electric. And this is a stock that if you had bought it at the end of 99, so assuming the closing price of $1231.99, it was trading for about $51.50. That was going back and adjusting for splits. So after adjusted $51, I think it was actually $160 or something at the time. Bought it for $51.50, held it through the end of last week. The stock was about a little over $16. If you had assumed 500 shares that you owned at the time, that would equate to roughly $17,500 loss just in the stock, not accounting for the dividends. It has about a 4% yield now, so if you add back in the yield, which was $4,700 worth that you took in, and just set that in cash, the stock is very, very important. You look at a GE, it's down 6 or 8% this year. It's still yielding 4%, but then you look at the other side of it, and the Philip Morris International PM is up 30% this year, and it's still yielding 4%. So it was yielding
much higher than that, at the beginning of the year. So there's certainly lots of things. Philip Morris International is certainly one that we've talked about in the reports and on the videos, but certainly being aware and looking for those types of yield plays. And there's lots of ways to do that on the site. One of our newer ETF models that we have is the Wisdom Tree Dividend ETF model. So it's buying ETFs that are dividend focused, so it's going to provide the yield in the portfolio, but it also has the relative strength overlay on top of that. Lots of other ways too. Even if you do UITs, First Trust, and we have a UIT through First Trust that's designed to focus on high relative strength dividend paying stocks. So there's lots of ways to gain that exposure out there, but just certainly being cognizant of that is important. So
now, a couple of weeks ago, Ben, I asked her, I said, Ben, put together for me an income producing portfolio. Now, I'm in that situation where I'm more interested in income and growth. So I buy these stocks. I look for these kinds of stocks that I can put in that stock, and typically I'm trying to find, stocks that have yields of 3% or higher in an almost yieldless environment, and then augment that yield by covered writing. Now, some of the offshore drillers or oil service companies I own, I don't write against those.
But I typically, if you look at my portfolio, I probably have a yield of I want to make sure that corporate bond ETFs are going to be in that matrix. It could be up at the top, this time next year. And so simply I run that matrix on a weekly basis, and if there are any changes, I'll let you know. Yeah, but then what happened was the matrix, you took the top 10, top 20, top 5. I bought about 10 stocks, I think. Yeah, it's a rather large matrix that we can run internally. So what you did is you bought the top 10. And in essence, what I'm getting at here, I'm trying to pull it out of him like I'm a dentist. As I came to him and I said, look, fish, go in that pond and fish. Take those fish, put them into a matrix. Then that matrix will list the best fish to the worst fish. Out of those fish that we caught, I'll take the top 10. I don't need to even know what the name of the stock is, or the symbol. I'm taking the top 10. I already said fish in this pond. I already said here's how I want you to fish. Here's what I want to do. I want you to have an arm wrestling contest with them all. I want the best fish, so I'll take the top 10 fish. And if that changes, you let me know. And he'll get an email, and he'll run that program. And if a change takes place in that portfolio, I'll get notified by him. I'll simply take out a symbol. I'll replace it with a symbol. It's about a 4.5% yield or something like that.
Yeah, that's about the average yield in that portfolio.
4.5% yield?
Yeah, and it's neat because it's a rather diverse universe. And what's interesting is that if you look at that the top 10, I mean, not only do you have some equity funds, but you also have some fixed income.
You see, the point is, this is where it's going down the road. It almost at this point in time is not necessary to look at the chart. Like you can land a plane, you're probably not even aware of it, but when you're sitting on a plane and it's an airline, that pilot is required to allow that plane to land by itself, computerized landing, X numbers of times a year. You don't know what day that is. But it might be in the fog, or let's say you're instrument rated and you're coming in the fog, and even though you're in control of all of the controls in that cockpit, you can't see. So you have to use radar. So in essence, we're using the radar. We're saying, okay, here's how we know we need to get this plane to take off and land, and our system will do it. The point I'm getting at is ultimately this is going to be on your phone. Ultimately, you'll be on your iPad and you'll be on your phone, and you'll be able to do these things automatically and manage your portfolio through DWA on your iPad and your phone.
Mm-hmm. Absolutely.
That's coming.
Yeah.
What I would love to hear from any of you is what app do you use on your iPad or your iPhone that you really like, the way it feels and the way it looks? Email that to us. I want to see it because we're in the process now of creating, I want to have it, the absolute state-of-the-art app for investing. It'll be Dorsey Wright Things, and it'll be primarily for our professionals. It'll be called DWA Away. You know, so when you take off, if you're in the Serengeti Desert or plains, you can manage your customer's portfolio effectively right from there with everything you could possibly need.
Yeah, I mean, if you have
without going to the site.
Right, if you have an iPad or maybe an Android device, just let us know. Because there's millions, almost millions of apps out there right now, and there's so many that are already tailored to the financial industry.
Here's something. I'm sorry.
I was just going to say, even if they're not tailored to the financial industry, I've seen one that we were looking at the other day was a light or a app called Cooking Light, and it's pretty interesting how it allows you to mix and match the different entree courses and appetizers, and it'll give you on the right hand side, it'll show you whether it's got too many calories or too much this and that. So that kind of stuff too. Yeah, that's pretty
Cooking
interesting.
Light is cool.
Yeah.
And there's Flipboard. If you don't have Flipboard, go get that. It's free.
Yeah.
Flipboard is cool in the way it feels and whatnot. We want to have the absolute best app available. Mm-hmm. So we're going to do it.
Yeah.
Here's something cool to look at. I'll leave you with this. TheStreet.com. Go there. I typically never go there, but on my iPad, I happen to see these cool things like 17 products that were invented by accident. Goldman Sachs' 10 best stocks. Worth looking at and then checking the charts on them. Dividend calendar. Find ex-dividend dates. Merrill Lynch's top 10 favorites. All kinds of interesting things in here about the top 10 this, the top 10 that. And I guess they do it this type of year. Rogaine was a mistake. Viagra was a mistake. Viagra was
Velcro.
Velcro a mistake. Coca-Cola and Pepsi were mistakes. They were medicinal purposes. You know, I mean, it's interesting. So there's a lot of cool stuff there on TheStreet.com about the different products and stuff like that. It's kind of interesting.
Yeah.
So at any rate, I guess that's enough for today.
Guess that's it.
Nobody's watching anyway.
Guess we'll talk to everybody. What?
Okay.
Have to be after Christmas, right?
You
When we
got
come
it.
back next Monday, yeah.
Right. See you then.